Hello again. Here is now the promised small video on the credit method. The basic idea of the credit method is that foreign tax is not deducted from the tax base, but, and that was my mistake just now, but it's deducted from the tax. So the amount which you owe to your fiscal administration in the state of residence, that amount can be lowered exactly by what you already paid abroad. That means, in the final effect, that if your tax in the source state was 50, and your state at home would be 60, that then you can deduct the 50 from the 60 and only pay the remaining 10 to your state of residence. So what you have already paid abroad can be credited by the home state. So what you already paid abroad need no longer be paid at home. That means economically, the state of residence indirectly pays your tax in the other state. And in the total, it means you only pay the tax once, because you pay abroad a bit and the remaining amount only to the level of your home state tax in your home state. And that is the great advantage of the credit method. You end up with the tax level of your home state. Well, there is nevertheless one modification or one important restriction. Imagine the foreign state doesn't take 50 but 70 as a tax. And your home state again 60. Then they reduce their tax claim only to 0, so by the 60. They renounce at maximum on their complete tax, but no more. You don't get a refund for the exceeding 10. So you either end up with the complete level of tax being 60. That would be the case if you pay 50 abroad and then 10 at home. Or you end up with the tax level abroad. If you pay 70 there, then your 60 at home are reduced to 0, and you end up completely with the 70 in the state abroad. In the final effect, so you end up with the higher tax level of the both countries. But nevertheless, you have a reduction of a double taxation to a taxation only once in the final consequence, because either you have exactly the same tax burden as at home, so the aim of the unlimited tax liability has been achieved. It has not become cheaper abroad than at home, but on the other hand, it has also not become more expensive. Or other alternative, if abroad the tax level is higher, then you end up with their tax level. But fun fact, then you only pay the same high taxes as everybody else in that market pays. And so if they all can afford to pay that high tax there of 70, you can also live with that. So there is a reduction to one level of tax, although it's the higher one. Good. Let's keep an important subtotal, or let's draw an important line to sum up in between. You can offset what you already paid abroad under the credit method against your tax liability at home, but the upper limit for that credit is always what you pay at home, naturally, for these amounts of your income, so for that part of income. Well, again, to clarify that, here you see it. If at home in Germany, let's say you pay 60, by the way, before illusions come up, Germany does not have a tax rate of 60% at the moment. The highest German income tax rate is 45, but 60 is such a nice figure. You can illustrate things easily with that. And from the 60, because it does not exist, you see it's just an example. You don't have to check why and where I got the 60 from. Okay. If you pay 60 and you paid 50 abroad, you pay 10 at home. On the other hand, if Germany wanted 60, you already paid more, then you end up with a German tax of 0. Just to illustrate how that would work, on the left side here you see the data of a case. Somebody has a job at Kleve, 70,000. Gets interest from a bank account in Brazil, 100,000, that's taxed in Brazil with 10%. And dividends from shares in a company in Brazil, again 100,000, taxed in Brazil with 30%. The small little asterisk, by the way, before the name Brazil just means this is now an arbitrarily chosen example. So I don't guarantee for the tax rates in Brazil. I just needed a name for a country, so I just chose some country. Good. Our taxpayer then has special expenses, so personal allowances of 10,000, which can be deducted from the total of the income. Now let's solve that case. Let's begin first with checking the personal tax liability. Here our taxpayer F is a human being, so a natural person, and lives in Germany. That's assumed here, so we have unlimited tax liability, and the worldwide income is indeed taxable at home. Income from the German employment is 70,000. Okay, that's plain and clear, no problem. The interest is income from capital. It is taxed separately from the rest of the income with a fixed rate of 25% under German law. So herefore, you have to pay in Germany 25,000. Now we can directly check the credit method or apply it. In the foreign state, 10,000 have already been taken, so the remaining balance which has to be paid to Germany for that item is 15,000. The dividend is also income from capital. That means it is not a part of the regular income, but separately taxed as capital income. Again, the rate is 25%. So again, we end up with 25,000. Now we compare that what has already been paid abroad, that is 30,000. So the final tax in Germany is 0 for that. Now add up everything which is taxed under the regular taxation. That would be 70,000 minus 10,000 is 60,000. We determine the income tax under the tariff function for that. That would be in 2021. 16,063, and that's it. As you see in the last case, I always determine for every individual item the credit limit, so the amount of the German tax which refers to that particular income. That's really easy, and it was really easy in that last example, because for income from capital, that credit limit is always exactly 25%. Now, when it comes to the question how the German tax for other parts of income can be determined, then we are confronted with a rather difficult problem, because for non-capital items, the tax rate is progressive. So it varies between 0 to 45% depending on how high the worldwide income of the taxpayer is. And the problem is the tax tariff function only gives a result for the worldwide income. It does not directly give any result for a particular item of the worldwide income. So we have to make some assumptions. If, let's say, 16,000 for the worldwide income come out, how much of the 16,000 refer to 1 or 2 or 3 different parts which constitute that income? So we have to think about that a bit. Now, what does this mean in a concrete case? Here you see an example. Mr. G from Kleve has now income, and it's not only income from capital. The business income is from Kleve, 60,000. Then we have income from lease and rent from Goch, that's also in Germany, 30,000. This is a loss. Then we have income from a farm, and the farm is abroad in the city of Is Not So Bad. That is somewhere in Faroestan, 60,000 plus. So if we draw a subtotal, we have now 90,000 total income. And now from that, all these sources of income, we can deduct the special expenses of Mr. G, 30,000. So we end up with a total taxable income of 60,000. And the total German income tax for the year of 2021 for a total taxable income is 16,063. And now imagine we have paid some taxes in Is Not So Bad. The question is now, where is the limit for crediting these taxes? For this, we must know how much of the German 16,063 we pay for exactly the income from the farm in Is Not So Bad. There might be different logical approaches how you can attribute the 16,000 to the different three, or rather more, two parts of income which contribute to the tax claim. Let's begin with the first idea. You could compare all the positive parts of the income and say, well, as a tax can only be levied on the positive parts of the income, we just look how many positive income elements were there, and now we look how high the percentage of the income from Is Not So Bad is in relation to the total positive sources of income. If we choose that approach, we have income from business 60, we have income from the farm and Is Not So Bad 60, and all the positive income is 120,000. And then the 120,000, that would mean the farm has 60% contributed to that. So we have 50% of the income is foreign, 50% of the tax relates then to the foreign income. 50% of the tax would then be 8,031.50. Good. So that means we could credit the foreign tax up to a limit of 8,031.50. Now, that's not the only logical, imaginable approach. We could also say we look to the total, so the sum of all the income achieved worldwide, so including the losses, and then we end up with different relations or ratios. The business income is 60, the farm is 60, the losses from lease and rent lower that by 30,000. So the total which we have after we sum up all the income all over the world is 90,000. Now, the special expenses or private expenses have no direct connection with the income, so we leave them out and say they have nothing to do with where the income comes from and what the income is, so we leave them out. Then you could compare the relation between the income from the farm in Is Not So Bad and the total from all types of income. That would be 60,000 in relation to 90,000. That's a ratio of 2:3. So 2/3 of the total tax would then refer to the foreign income. 2/3 of 16,000 would be this year 10,708. So if you paid for the farm in Is Not So Bad a local tax of 12,000, you could credit it to the German tax to a maximum limit of 10,708. Under the first approach, it would have been cut off after 8,031. So you see which approach to determine the German tax which relates to the foreign part of the income, which approach you choose is highly important and leads to different results, and that means a different amount of money which can be saved. You cannot leave that to the individual decision of a tax official, a tax court, or the taxpayer himself or herself. You have to determine the way how the credit limit is calculated under the rules of the tax law. And that's even not the full message. You can even conceive a third way to determine the percentage of the income. You could say we compare the income from is not so bad with the total taxable income, so what is left over even after the special expenses have been deducted. In that case here, and that's a mere coincidence here, a very surprising result comes off, because then the farm income is 60,000 and the total taxable income is 60,000. So under that perspective, all what you pay in Germany is paid for the income from is not so bad. Economically, that would mean that all the losses and all the special expenses are set off against the inland parts of the income, and that then the remaining rest is taxed by German law. In that case, you have now 16,000 which can be credited as the maximum. So if again the foreign tax would have been 12,000 and it's not so bad, then here you could credit the full 12,000. If is not so bad had claimed 18,000, you could indeed still deduct 16,063. So you see, which method a legislator decides for is enormously relevant. By the way, if the credit method is established or agreed upon in a double taxation treaty, this very, very decisive aspect, which method is used to determine the credit limit, is usually left to the individual decision of one of the states. Usually in a treaty, they just say we agree on the credit method, and how the credit method has to be applied in detail is determined under the local law of each state. So the states are left with an enormous space or possibility to decide over the details, and that has enormous financial consequences for the people involved. Let's have another small look on that last method here. Mathematically, this last method is identical to another approach, or you can express the last approach in a different way mathematically, because foreign income in relation to total taxable income taken or multiplied with the total income tax is equivalent to foreign income multiplied by total income tax in relation to total taxable income, and total taxable income total income tax in relation to total taxable income is nothing else than the average tax rate of an individual taxpayer. So that is the reason why this method can also be called the average tax rate method. It's a very convenient and easy method, but as you have seen in the last slides, it is also the variant of the method which is the most generous one, and so the most expensive one for the fiscal administrations. Now, the first two methods are called, sometimes in contrast to that, the proportionality method, because here the credit limit is determined according to the ratio between the foreign income and all the items of income from all over the world. Which methods can we find in German law? Well, It varies. In former times, we had the proportionality method everywhere, but then upon critique from the European Court of Justice, which showed that the proportionality methods could lead to some unfair results in cases of natural persons obtaining income from abroad and having special expenses, we turned over to the average tax rate method in the field of income tax. You can find that legally laid down now in paragraph 34c, section 1, sentence 2 of the ESDG. The ESDG is the German income tax. The corporation tax, nevertheless, was still fixed to the old method, so it has been clarified when the method change was introduced into the Income Tax Act. There was a clarification in the Corporation Tax Act that although the credit method can also be applied for a GmbH, the calculation method for the credit limit is still the old way, the proportionality method, and I believe it's the second variant, which we in Germany practice. Well, now there is naturally one question left over. For which income are we so generous that we do not only grant the deduction method but the credit method? And the answer is laid down in the law, naturally, again in section 34c, paragraph 1, ESDG. First, we only grant it for foreign income. So the idea is, if a foreign state indeed dares to tax German-sourced income, this is so unusual that we are not going to pay the bill for it, neither directly nor indirectly. And we would do that if we would accept the credit method for such cases. So we grant the credit method for foreign income because there, if you earn money abroad, we regard it as natural, unavoidable, and legitimate that the foreign state where the income comes from taxes that money. And so we only take the difference which remains to our national tax level. On the other hand, we regard it as natural that the state where the money comes from taxes that money. Now, if a third state interferes, let's say you earned money in a foreign state like Mali or Boni or Sconti or wherever you earned your money from, then we would accept the local tax of all these states as natural, legitimate, and something which should be credited. But if a third state like Libya interferes and also tries or really does tax the income from Mali, Boni, and Sconti, then we would say, what has this state to do with that? Why should we indirectly bear the fiscal burden of that? So we don't credit foreign income tax, which was not levied by the state where the income was earned. By the way, it could, under the international financial order, it could be happening that such a state levies a tax. Just imagine you had a residence not only in Germany, but a second residence in the country of Libya or Farawaystan or else, then they also might have a right to tax your worldwide income, so that the German worldwide income tax claim collides with their tax claim on the worldwide income. But then Germany says, well, that's a luxury problem. Nobody needs two residences. And even if two residences for the taxpayer were indeed necessary, there is no God-given reason why it is we who should give in. And so for such a situation, we only grant you the deduction method. So we only grant you the method which saves you from bankruptcy, but nothing more. So keep in mind, the basic decision which we have unilaterally if there is no tax treaty, then we say we grant the credit method only for foreign income and only for the income tax of that state where the foreign income was earned. That gives you already a good overview over what happens. If you want to find that and check that in the German law, here is a nice small translation of paragraph 34c, first section, the credit method, and the decisive words have been highlighted by me. Well, taxpayers must be subjected to unlimited tax liability if they are subjected to a foreign income tax with their foreign income in that state from where this income is derived, then credit is possible. Yeah. Now, it turns out to be a key factor if income is foreign or if it's German. Also, that decides about can you claim a credit or can you only claim a deduction. And the economic consequence of that is enormous. If you can claim a credit for 1 million foreign taxes, you save up to 1 million payments. On the other hand, if you only can claim a deduction, your income goes down and perhaps 15% of the amount are saved as income tax, 30% depending on your personal rate. So also what is foreign and not foreign is highly important, and so the tax legislator also said we can't leave that to what an individual official or individual judge thinks about the situation. We must make a clear list of what is enough connected to a foreign territory in order not to be regarded as German anymore. So the list is in 34D. Here you have a list which you can always check from the beginning to the end. If you find at least one entry which fits your situation, then you can be happy, then your income is foreign and you can claim a credit. Agriculture and forestry, if the farm or whatever it is situated in a foreign state, seems to be clear. Income from business, big surprise, is only foreign or foreign enough if you have in the foreign state a permanent establishment or at least a permanent representative, and that establishment or representative was involved in the transaction in play. So what does it mean? It means that if you only produce goods in Germany or services are rendered by a German firm to a foreign customer, and even if you visited the foreign country to render these services or to deliver these goods, it plays no role. It's still the profit of a German firm, so it would not be regarded as foreign. Only if you opened up an establishment, an office, a factory, or something else, a permanent establishment in the other country, then we would accept this as foreign income. Self-employment, so if you act as an artist, an entertainer, a scientist, or so, is foreign if the person in play exercised his or her services abroad, or if the results of your work have been transferred abroad and used there. If you sell assets, then if the assets are located in a foreign state, the profit is foreign. If you sell shares in a limited company or so, if the company has its seat abroad, the share income has enough connection to a foreign state to be regarded as a foreign profit. Dependent work is foreign if you worked in a foreign state. Income from capital is foreign if the person from whom you get that capital income is foreign. And the last type of income, lease and rent, is foreign if the immovable property is from a foreign state. And the last income, the other income, is foreign if individual conditions are met. For example, if you get a pension payment, if the pension payment comes from an institution in a foreign state, or if you sold private assets which are located in a foreign state, etc., etc., etc. So that makes income foreign, and if you have foreign income, you can use the credit method. Now, another question remains, and that is, can a state really afford to be so generous that unilaterally, without a tax treaty, you grant the credit method to all investments in all other states, even in tax havens or no tax states, without harming your own economy? And the surprising answer is yes. The reason for that is simple. Imagine somebody of your taxpayers invests in a country where the local tax rate is only 1%, so he or she only pays €1. Then you can credit only the €1 and the remaining tax in Germany would be 59. You end up with a tax level of 60, as if you had invested at home. If there is a foreign country where they take no tax at all, you could get a credit of 0, and then you remain with the full 60. So whatever the foreign state taxes, a high tax or a low tax, you can always give the credit. The outcome can never be cheaper than at home, and that was the primary aim behind the unlimited tax liability, which is then still fulfilled. You preserve or you prevent every harm for your home state activity, which could be caused by the low tax level abroad. So no problem there. You can always be so generous that you grant the credit method worldwide. And that is the reason why the credit method is not only found in a double taxation treaty in Germany, but in many states, and in Germany too. The credit method is also and already granted unilaterally. They grant it already alone without any need for an agreement, and say, to avoid double taxation treaty, you can get the credit method. The only thing which you naturally need to decide is, when do you want to be so generous, and when do you want to say, no, we restrict ourselves to the absolute necessary, so to the deduction method. That is what each state can freely decide. The Germans, as you saw, took the decision, we grant the credit method only for the foreign tax which was levied by the state in which you earned the foreign money. One could decide otherwise. Now, there are also double taxation treaties concluded, and there remains naturally one question. Why, if the credit method can and is usually granted unilaterally already in the home state law, why do such states then still conclude double taxation treaties to avoid double taxation? And the answer is, remember situations like somebody has 2 residences, and that person is now taxed by 2 states on the worldwide income. Then you would have to decide which tax can be credited and which can't. And in our example, Germany would have said, well, for the second residence state tax, you don't get a credit. Or there might be situations where a foreign state says, this is from my perspective income from my country, but where under the German catalogue of foreign income, the income does not count as foreign, so there will be no credit. So usually in the unilateral rules, there are certain gaps where a foreign state can take a tax and you don't get the credit at home. So you might up there with a genuine double taxation, or you might have to change over there for that amount of tax to the deduction method. And that is either prohibitive if you get nothing at all, or it is really a considerable additional financial burden if you only get the deduction method. And that is the reason why, to close these gaps in the application of the credit method, countries then still conclude a double taxation treaty. So usually in a double taxation treaty, there are clear rules. Everything which the foreign state can tax under the treaty will be credited at home. And the reason why they have to negotiate about a double taxation treaty is naturally that when there are different ideas about what is foreign and what is not, the two states will have to do some negotiations. The income A is not taxed by you, the foreign state. It's only taxed by me, the home state. You renounce on taxing it because we agree on this is not really foreign. This is something which belongs to the home state. On the other hand, then the type of income B or so, yes, that is something which you may tax, and then we are going to credit that. So that's usually why and how a double taxation is still necessary, a double taxation treaty. Good. And that explains why double taxation treaties are also concluded by countries which normally also unilaterally grant you the credit method. Okay, now what will we have to do afterwards? We will have to think about examples how the credit method could be applied and which case constellations could show up. And this, I think, ladies and gentlemen, is again a subject for another small video. So let's stop here and enjoy a small break and go on later. Thanks for watching, and I hope to see you soon back again.